If you're committed to reaching your goals, then let your goals make your decisions. In any buying situation, consider your must-haves. Are they needs or wants? Know how much you can afford, whether you can pay cash or will you use credit. What is the product worth to you? Do your research. Ask yourself which product fits your needs. Which is the best value? There are some essential goals that we all should share because they're critical to safeguarding our financial futures. We've already talked about savings for retirement and emergencies. Remember, an emergency fund covers the unexpected, such as a job loss, catastrophic car or home repairs, medical bills, and any other unexpected expense or loss of income. At least one of these things will hit each and every one of us at some time. Think about it like this. Nothing is an emergency if you're prepared for it. Keep in mind that a 401k or pension is not the same as an emergency fund. That's because you can't get to the money easily. If you had a real emergency, you'd have to go through some red tape and face early withdrawal and tax penalties. Also keep in mind that loans and credit are not equal to an emergency fund. When you take out a loan or put money on a credit card, you will have a new monthly payment. That payment includes interest and may put you into the red at the end of the month.
A tip that helped me start to save is Automade to accumulate. Some people call this paying yourself first. You can set up an automatic draft from your checking account to a savings account. You can use the same bank or set up an account at another institution. This is what I do. I set up an automatic transfer to correspond with my paydays. So every other week, I'm adding to my emergency fund and IRA. I use another institution and make it a bit more difficult for me to get my hands on that money. It's the deterrent I need to leave that money alone and let it grow. You can also have a payroll deduction go straight into savings or another account. Any method of automatic will help you build more savings. If the money is not in your checking account or in your hands, you can't spend it as easily, and chances are you won't. Forget about the money in that account and let it grow.
Now let's discuss another essential goal, insurance.
Insurance is basic to financial security and is more a need than a want. It's one of the foundations upon which we build financial victory. Of course, nothing is foolproof. Insurance for something truly catastrophic often isn't affordable. But having no insurance can be a catastrophe in itself. Before we get into the specifics of insurance, let's review the basic terms. Insurance costs money. The payments for insurance policies are called premiums. If you don't pay your premium, the policy will lapse and you won't be covered. Most insurance policies have deductibles. For example, if you have a $200 deductible on your health insurance, your insurance company won't pay anything until you've paid at least $200 in medical bills. Exclusions are conditions or services that aren't covered under a particular policy. For example, a health insurance policy could exclude pre-existing medical conditions for a period of time. Another example is a homeowner's insurance policy that excludes flood damage. There are many types of insurance, but the most important are health, disability, life, vehicle, and homeowners or renters insurance. Let's start with health insurance.
Medical care is a need. Because today's medical care is so expensive, everybody needs medical insurance. Many people have group health insurance through their employer. A group policy is based upon a pool of people, so the cost for healthy employees is average with the cost for those with health problems. This keeps the prices down for the whole group. If you don't have access to group health insurance and you are not eligible for Medicaid or another free insurance, first take a look at the Health Insurance Marketplace, www.healthcare.gov, to compare plans and prices based on your income. You may also want to consider getting less coverage for less money. This way, you will have insurance if something really bad happens. For example, if you have a $1,500 deductible, the insurance company won't pay anything until you've spent $1,500 in a calendar year. But if you have to stay in the hospital, you'll be very glad you only have to pay the first $1,500. Also, most high-deductible health insurance plans make you eligible for the tremendous savings of an HSA or health savings account. If you can't afford even the basic health insurance, consider making changes to your budget, even drastic ones, so you can afford it. You can't afford not to have health insurance. It's a need, and we must adjust our wants to provide for this need. In 2010, the Patient Protection and Affordable Care Act was approved. You can shop for coverage and compare rates and plans by going to www.healthcare.gov. For Americans making less than 400% of the federal poverty level, there are discounts in the form of subsidies to reduce premiums and lower out-of-pocket costs. If you have lost health care due to a change of circumstances, such as losing a job, go to the health insurance marketplace. You could be eligible for coverage and discounts and may be able to get a less expensive plan if losing your job left you with an option of an expensive COBRA plan.
Now let's look at vehicle insurance. If you have a car or truck, you need vehicle insurance. Many states won't let you register a vehicle without it. Without insurance, if you cause an accident and someone is injured, you could be sued for hundreds of thousands of dollars in medical costs and damages. If you have a loan on your car or you lease, the company that finances or leases your vehicle requires that you have insurance listing the company along with you as the loss payee. The lender or leasing company will consider any lapse in your insurance breach of contract. Then the lender can force you to pay them more expensive insurance or even take your vehicle by repossession. As with anything, learning more can help you save money, and there's no substitute for sitting down with an expert. Many insurance brokers have little training, so look for someone with credentials.
And that brings us to the next type of insurance we'll need: life insurance. Laws differ by state. While there are some exceptions, your heirs or family are usually not personally responsible for debts that are solely in your name. Talk to a lawyer licensed in your state to find out for sure, but the point is that generally, your life insurance should not focus on your debts. Rather, it should provide for the people who depend on you for financial support. Life insurance should match your financial responsibilities. If you're single and don't provide for anyone else financially, you may only need enough insurance to cover your funeral. But if you have a family that depends on your income, you'll need enough insurance to replace your income should you die. There are internet tools that let you estimate how much life insurance you will need. Before choosing a policy, learn more, comparison shop, and talk to an accredited insurance professional about how much coverage you need. Consider term life insurance if the purpose of the insurance is to protect your family's income for a specific period of time. For example, while your children are still at home and dependent on you. Whole life insurance will also protect your family's income and protect against estate taxes if you face that issue, but will be much more expensive.
Now I'd like to caution you about two mistakes I've seen when it comes to life insurance. First, there is a thing as too much life insurance. I've seen people pay several $100s a month for life insurance, leaving them unable to cover their living expenses. This usually happens when parents insure not just themselves, but their children. Remember, life insurance should replace the income of the person who dies. Since most people don't depend on income from their kids, this is definitely a bad choice if it leaves you unable to balance your budget. Two types of life insurance that you probably do not need are mortgage insurance or credit life insurance. Mortgage insurance pays off your mortgage lender if you die during your loan. So mortgage insurance protects the lender more than it protects your family. Do you really want the money to go to your lender instead of your family? If you have enough life insurance, your family can use it to pay off the mortgage and keep the house, or they can sell the house and buy another one. With mortgage insurance, they won't have that choice. And it's usually more expensive than life insurance.
There is one possible exception I can think of. Mortgage insurance may be beneficial for somebody who is in poor health and life insurance is unattainable or too expensive. If you are considering mortgage insurance in this situation, check the small print for restrictions and make sure it will cover your pre-existing condition. Can you tell us more about credit life?
Credit life is similar, but it's for non-mortgage loans. Credit Life pays off the car lender or other creditor if you die during your loan. But remember, your family is usually not responsible for these loans. Credit Life is expensive, and lenders often push it and act as if it's because they care about your protection. The real reason is because it's profitable to them, and the loan is paid upon your death, even if your family is not responsible for it. Credit Life protects the lender much more than you. You're much better served with life insurance. One final tip, try to buy enough insurance in a single policy. If you buy multiple policies, you'll duplicate some costs.
The next type of insurance that most of us need is disability insurance. Did you know that you have a much greater chance of being disabled than dying during your working years? It's true. That's why disability insurance may be even more important than life insurance. Try to have disability insurance that pays at least 60% of your salary and starts 3 to 6 months after you become disabled. Make sure it continues until retirement age and look for a policy that has a broader definition of disability than the Social Security Administration's.
Let's finish our look at essential insurance with homeowners and renters insurance. If you own a home, you need homeowners insurance. If you rent, renters insurance is very affordable and will protect your belongings. Think of it this way, insure to be sure. You can avoid many pitfalls by insuring the most important financial elements of your life.
In summary, to reach our goals, we must have a plan. Our goals will differ based on what's most important to each of us. Proper insurance and emergency funds are essential goals, because without them, we could lose everything else. We all start at different places, but with patience, persistence, and desire, we can all reach our realistic goals. Decide what's most important to you. Follow the steps in this unit, and you will be more successful in reaching your goals. Use effective financial goal setting to create your own goal map, and make sure to write it all down. Insurance is an essential goal, so be sure to have enough of the right types of insurance for your situation. Insurance is what protects you as you work towards your other goals. You need to have both an emergency fund and retirement savings. The emergency fund is money you can get to quickly without penalties. Your retirement savings should be invested for long-term growth.